So in today's training, I'm going to go ahead and explain a little more of some of these strategies and how you can build your credit, especially if you have thin credit, meaning that there's not a lot on your profile. As I mentioned in previous recordings and trainings, that there should be a minimum anywhere from 3 to 5 revolving accounts. Should have about 1 to 2 unsecured installment loans. So that's going to be on your unsecured family, where your limits kind of really help dictate what kind of unsecured loans that you can get. Then you want to go over to the secured side, where we are looking at auto loans and mortgages. And so there's 2 different categories, from that. Now, the stronger the credit you have, the more limits that you have access to, that can then roll that back into obtaining additional business credit from that. So the stronger your personal credit, the more business credit you can get. So the combination of the 2 is very powerful. So here are some elements. So I'm going to go ahead and frame this as if you have nothing on your credit report. So what would you do in this case? As I mentioned before in previous talks as well, that there's certain tiers with your credit coming straight from FICO. There's 4 tiers associated with how FICO rewards you with scoring systems. So number 1, your tier 1s are going to be your Chases, your Wells Fargos, Bank of Americas, and your Cities. Your tier 2s are going to be your American Express, Discover, Capital One, TD Banks, a lot of those community and not the big boys on the tier 1s. Then your tier 3s are going to be your credit unions, and then tier 4s are going to be your Fintech, Synchrony Bank, those type of lenders. So if I had to choose of putting up money for a secured card, I would rather give my money to one of the tier 1 banks, right? The perception of what's on your credit report can make a difference. So there's always a little yin and yang about, okay, well, what's more important? A lot of accounts and trade lines, or having the right type of brand names on your report. So I wouldn't want to go to, the mall and the Gap type of commodity bank, lenders. That's going to be more of your tier 4, ratings. So when an underwriter later on in the future, when you're going for $100,000, $200,000, $500,000 loan, an underwriter is going to look and review your credit profile. They're going to see that you have a bunch of these tier 4 and tier 3, lenders. It doesn't make the perception as strong as if it was your Chase and Wells Fargo's. Does that make sense? So if you do have some of the capital that you can invest and you want to get your 3 to 5 minimum revolving accounts, I would choose your tier 1s and your tier 2s if possible. Another resource is your Experian Boost. So if we're dealing with, let's just say, lower amounts of money, and you're not wanting to put up $5,000 or $10,000 for a secure card, you can always start off with like a $200 and then work your way up and add more in the future. But Experian has their Experian Boost. So if you're paying for your Netflix and utility bills, then it might be a good idea to add those type of accounts, because we want activity at the same point. So coming back to my previous statement, if I had to choose between the tier 1s and putting money towards that, or getting some of these fintech companies that I'm going to explain a little bit further on here, I would probably want to say the combination of the 2, because I know that having activity or lots of accounts and trade lines is important. So that's a little bit my own thoughts and feelings. So another one here is going to be your rent reporters. So if you're renting, especially in the last 2, 3, 4, 5 years, you've been at the same spot and you're paying on time, you can then add a company like Rent Reporters. There's a lot of them out there that they can age what you're paying for rent for up to 2 years. 1 or 2 of these other companies, one of those competitors, I think they can go actually even further now, maybe about 5 years. So, but don't quote me on that. You might have to do your research, on that. So why is this one important? Because the age factor of what's on your credit report can make a difference, right? If we go back to the perfect credit formula, there's 4 different types of accounts: your revolving, auto, installments, and mortgage. So this is going to be categorized as an installment loan, and the age factor is the next category there. The longer of establishment, the higher the score goes up. So by having a mixture and having the age, it's going to be the closest path of you getting stronger credit. And so you should have about $50,000 to $50,000 in total accounts. That's going to help you in the future. Everything in finance is the law of 2, right? 2 years age of history, 2 years trade lines, 2 years tax returns. Everything always follows that law. Next is going to be your credit unions. I honestly love credit unions, what they're about, not charging you all these additional fees, but there's a tremendous amount of credit unions, federally or statewide that can really be an essential asset to help you get and rebuild your credit faster. Okay, one that I like as well is called DCU, Digital Credit Union. So they have a credit building loan, and if once you become a member with them, then they can give you actually up to $3,000 on a 5% 84 months. And this could be one of those, tactics that can help you strengthen and, from it. And I'm not sure if it's secured or unsecured from this, but a lot of these credit unions can provide you an unsecured, line. So if you're in the stage right now where you have bad credits or there's something that needs to be corrected on your credit report, the challenge with credit repair is that you're in a certain status and you're not building and strengthening your credit profile from there. So these are some tactics that you can implement if you're in that stage, or if you're in the credit repair process and you're waiting for that to be removed, wiped, fixed, whatever the outcome is, then you always want to be proactive in this case. So these could be all certain little tools and tactics to really get to that outcome a lot faster. Another one from Navy Federal, I think there's only about 1 or 2 credit unions that are doing this, but once you become a member with Navy Federal, you have to have some type of a military affiliation, either a family member. I know when I got into Navy Federal, I had put that I was on somebody that was in the military. I was living in the same household, right? It's another way of getting in. There's a lot of tactics on how you can get into Navy Federal. They are the #1 credit union that exists out there, but they have a unique program called a pledge loan. So you can deposit up to $100,000, whatever dollar amount that you're looking for, and then you can borrow back 95, 97, 98% of the money that you just deposited with them. So if I put up 100,000 and then a week or 2, 3 weeks later, I can pull that money back out, leave 95, 98, 90% of that, and it looks like it's going to now show that you have like a 2%, 3% utilization, and your monthly payments are going to be very, very low as it calculates. But now you have this long-term strength. So again, these are all certain little things that we can be proactive on. If you have money or you even borrow the money, you can just take it back out and provide it to the person who lent it to you, that you can do that. You can do that, think about 4 or 5 times with Navy Federal. So it's a great resource. Even right now, if you don't really need to build up your credit, but I think it's still a great resource to do that. So I might even do it for myself, and I have an 800 credit score because I want to be able to show strength, right? The stronger your credit profile, the more that the bank sees that can really help you be proactive here. So there's a bunch of these fintech options as well, right? Tomo Credit, if you don't really need a credit score. So essentially they're going to connect to Plaid, which is an automated platform that's going to look at your banking history, typically the last 3 months, looking at your deposits and cash flow, and they can provide you up to a $10,000 credit card based upon that feature. Okay, if you do have some income flowing through, then might as well, try that route. Another one is called SellerFi. You're paying your bills on time, utility, rent, just very similar to like your rent reporters or Experian Boost. That can also start adding trade lines at the same point. Credit Strong is a little bit of a different twist to a secured line or a loan, is that you're paying them a monthly fee to report a 5,000, 10,000. I think they can go up to 25,000. I believe right now they even have 3 different types. You have your revolving line, you have your installment on the lower end, and I think now they have created one that can go up to 25,000, where you're paying a few $100s a month to report a $25,000 trade line on there. Okay, so a lot of different options. Of course, there's a lot more fintech, credit unions, different options that you're able to tap into. It's just one that you have to ask yourself, how much money can I invest doing this? Do I want to do a secured credit card with the tier 1s and lock up that money? And after a certain period of time, once your credit is reestablished, you can then take that money back and it could be turning into an unsecured. Or do I want to go the unsecured route, do a fintech option, from here, or tap into the credit unions that, can provide you an unsecured line as well, up to $1,000, $2,000, $3,000, right? You do that, you stack it, go to 1, 2, 3, 4 different accounts. Now you're starting to get closer to that stronger credit profile with multiple accounts, even if you're in a bad credit situation or you have zero credit or thin credit from the topic of this presentation. Okay, so in the very end, we want to be able to be proactive by implementing these strategies and leveraging what's provided. The law of two comes into play. So what you do now is you're going to reap the benefit 2 years ahead of the road. So please be proactive, get in there and start building no matter what your scenario is. Okay, if you're already in a good credit position, then this is not something that you need to take advantage of. But if you are in 660 and below, then I would really tap into some of these to start building up your accounts. Okay, thank you.